Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Today's world is increasingly complex with scary financial issues on the minds of retirement savers and investors. There are many factors to consider when deciding where to manage retirement savings. Which way is the economy headed? Which securities are best? How are your returns doing? What are the tax implications for your investments? You can't afford to be blindsided or scared. Retirement planning is not the easiest thing to do. Whether you're planning your own retirement or helping a family member plan theirs, there's a lot of things to consider. This is part one in a two-part episode of Navigating Retirement, where I go over the 6 areas that can have the biggest effect on your retirement planning and how to properly manage those areas so they don't seem as scary. So this retirement planning video is meant to be shared with anyone that may find it helpful. If you think that your retirement-minded friends or family might be interested in watching this video, feel free to share it with them. Don't forget to copy or write down the link to this video and send it to them. There are several links below in the show notes section with valuable information you can use in your retirement planning journey. So, are you ready to learn more about the 6 areas that can have the biggest effect on your retirement planning? Let's get started. Number 1. Outliving our assets. A question oftentimes comes up of how can I avoid outliving my retirement assets? Well, how can we make our money last longer is another way to state that particular risk. Oftentimes, most people are concerned with making sure that they don't live longer than their assets last. And how you plan to avoid outliving your money in retirement is you have a written retirement income plan, something that we require at the Coastal Financial Planning Group, that all of our clients have and all of our prospective clients have before they make any financial decisions. What happens if you outlive your money is another question. What do I do? What's the alternatives? What if my income streams stop in retirement? What if my pension didn't have a survivor benefit on it and I'm a surviving spouse, so I don't receive that benefit anymore? What am I going to do if that money is no longer going to be paying me out throughout my retirement years? We outlive our money in certain circumstances, and we have to find other resources that will slip in and provide what we need to fit our cost of living needs. How do you reduce the risk of outliving your money? I already gave you a hint on that one. You have a plan. A written retirement income plan is going to help you decide where assets should be positioned now so that they can pay you later, and make sure that there's no income gaps or the difference between your income and expenses in retirement. The number 2 concern for retirees is inflation. And I know that we're all pretty concerned with that right now. We've seen the sheet of plywood go up 3 times, 4 times, 5 times or more. We've also seen the cost of a loaf of bread go up significantly. If we look back into the 70s, for those of you that are in retirement right now, I had a Sears catalog that I looked at that was printed in 1977. Now, I'm dating myself. I'm 62 years old right now. A lot of people might not even know what a Sears catalog is, but that's where we used to order a set of tires for our car. A set of tires in 1977 cost $80 for a set of 4 tires. Today, we're looking at close to $800 for a set of tires that are rated to last a little bit longer, but certainly we see the effects of inflation. How do we address inflation? We have that retirement income plan that spells out what specific inflation will and how it will affect each area of your expenses in retirement. So how does inflation affect retirement? Well, certainly it's going to affect you over a 20 to 30 year span of retirement, I just gave you a scenario where I looked back 50 years to the 1970s. What if we just try to project out the next 20 to 30 years of your retirement? How do you think inflation might affect your retirement plans? Does inflation affect Social Security? Well, it certainly does. The cost of what you buy is going to be bought with those same dollars that are coming to you from Social Security. And thank goodness there is a cost of living adjustment that's added to Social Security. So that will help protect you against some inflation. But will the government give us those COLA benefit increases in Social Security that actually keep up with inflation? That might be a question for us to look at again in a future episode of Navigating Retirement. What is the inflation rate that's used for retirement planning? Now, we look at a historical rate of inflation and we fudge on it a little bit. We pick the highest of an available option that we have in our retirement income planning formulas, and we try to project ours out at about 3%. Now, historically, that's quite a bit higher than what the actual inflation rate has been over the last 20 years. However, we feel that we're in an inflationary period. We should use a higher number just to play it safe. And inflation rates for retirement planning should play it safe, because if we live longer, that's one of the risks that can affect our future dollars. Our number 3 thing that we should look at, or risk that we should look at going into retirement, is market corrections. Now, I've often said in past shows of Navigating Retirement, what are our biggest retirement risks? I just covered inflation. I'm going to cover market corrections here. Another one is longevity. If we live longer, of course, there's more chances for market corrections to happen. And I would like to share this with you. If you're talking about the next 20 to 30 years, what do you think the probability of a market correction is to happen in the areas? 20%, 30%, 40, or even 50%. Remember, we had 2 of those 50% corrections back in the 2000 to 2010. So what's the current state of the market? We know it's been volatile. We know it's been volatile in a very positive way here for us recently. The market's gone up. But what does Newton's law of gravity say? What goes up must come down. To every action, there is an opposite and equal reaction. We can anticipate that the market will go down over a 20 to 30 year span of retirement. We just don't know when or how much or how long it will last. All of those things definitely can affect drastically your income planning in retirement. So we have to project out what the state of the market will be in the near term, and also out in the next 3, 5, 10, 15, 20, maybe even 30 years for your. What are the chances of market correction? Well, I always say that the market has 2 guarantees. One is it's going to go up. The other one, it's going to go down. Sometimes it's going to be flat. We're just going to see a 0% year, or a negative 1%, or a 1% positive. Those are flat markets. But typically we see up markets and we see down markets. A market correction, in my book, is a 20, 30, 40, or 50% correction. A 5 or a 10% correction happens very frequently. In fact, the S&P 500 will typically have a 5% correction every 3.5 months. So let's make sure we're planning on those market noise issues. They're going to happen. Let's just make sure we're protected against those big drops that could last for a long time in retirement. What are the risks if we see one, a market correction? Well, the risks that we may see are that we can affect how long our money lasts, which was our number 1 risk that we talked about today. So make sure that you're planning on market corrections. They are a fact of life. They are going to happen. How can you avoid market corrections? By having a written retirement income plan, by going through the 3-step review process, and also making sure that you have an income allocation plan so that market corrections don't affect your retirement income. Wow, you probably stopped and said, how does that happen? Again, you have an opportunity Plan ahead. Make sure that you have your income protected, and your investments can take a little bit more risk when you do that. Thank you for watching part 1 in a 2-part episode of Navigating Retirement. Today, we're going to get back with you on part 2, next episode of Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.